Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
All right, Steve, let's start with some breaking news from the Bank of Canada. They've decided to hold the overnight lending rate steady at 2.75%. This decision comes after a year of rate cuts and has left some real estate professionals wanting more reductions.
That's right, Sandy. The Bank of Canada has already cut its overnight lending rate by 225 basis points over the past year, and this pause seems to be a cautious approach given the current economic uncertainties. While some expected this move, others like Christopher Wine from Equiton feel a further cut could boost consumer confidence, which he says is at a 10-year low.
I can see why some are disappointed, especially with the U.S. trade tensions. President Trump's recent tariff threats on steel and aluminum could impact Canada's economy significantly. Considering we're the largest supplier to the U.S., it makes sense that there's a call for more supportive measures like rate cuts.
Definitely, Sandy. And while many commercial real estate investors could benefit from lower borrowing costs, especially those with variable rate mortgages or shorter-term financial needs, the Bank of Canada is cautious. They are monitoring not just domestic factors, but also the international trade developments closely.
It seems there's a delicate balance here. On one hand, there's a need to support the housing market, which is showing signs of cooling, as seen in Toronto's recent 4% decrease in average sales prices year over year. On the other hand, they must consider inflation, which has shown some unexpected firmness recently.
Exactly. And with inflation being a concern, the Bank of Canada is opting to wait for more data on how these tariffs and other economic factors play out. According to Phil Soper from Royal LePage, the stability of the workforce is another aspect they're watching closely. The upcoming rate announcements will be critical in managing inflation and economic growth.
It's a tricky situation, especially for developers. Jordan Kemp from Greywood Developments mentioned that development is a game of inches right now. A rate cut might not change the short-term outlook drastically, but it could provide some much-needed confidence to both developers and buyers.
Indeed, Sandy. It's about managing expectations and understanding that while rate cuts can provide relief, they aren't a cure-all. The path to loosening monetary policy is there, but with so many external factors at play, it's a complex environment for decision-making in real estate.
So, Steve, there's a new report from the Canada Mortgage and Housing Corporation that's raising some eyebrows. They're saying that to bring housing affordability back to 2019 levels, Canada needs to double its current pace of housing construction, aiming for between 430,000 and 480,000 units annually over the next decade. That's quite a leap, isn't it?
It sure is, Sandy. Doubling the pace of construction is no small feat. The Canadian Mortgage and Housing Corporation is suggesting that it's achievable, but it will require a significant increase in the workforce, more private investment, less regulation, and innovations in construction technology. It sounds like they are calling for a complete overhaul of the current system.
Absolutely, and it's not just about building more homes. It's about addressing the systemic issues that have been around for a long time. With the benchmark price index for all housing just under $700,000 last month, down from its 2022 peak, but still higher than 2019 levels, it's clear that homeownership is out of reach for many Canadians.
Right, and the Canadian Real Estate Association has noted these price shifts. But it's the supply gaps across major cities like Toronto and Vancouver that are particularly concerning. Toronto, for instance, needs a 70% increase in home building to address its affordability issues. That's a massive challenge.
And then there's Montreal, which the Canadian Mortgage and Housing Corporation says has the largest housing supply gap among the country's big metropolitan areas. It's a tough situation, especially when you consider that homeownership costs in Montreal have risen faster than in any other large city since the pandemic.
It's a multifaceted problem, Sandy. Prime Minister Mark Carney has set a goal to build up to 500,000 housing units annually across the country, but the Toronto Dominion Bank is skeptical. They published a report questioning whether the government can meet these targets, even with proposed policy changes like cutting the goods and services tax on new homes.
That's a fair point. The bank suggests it would take an unprecedented boost in productivity, almost a revolution in how housing is developed, to meet these ambitious goals. It's not just about building more, it's about building smarter and more efficiently.
Exactly. And while these measures might help, they might not close the gap completely. The Canadian Mortgage and Housing Corporation is clear that systemic changes are needed. The private sector and all levels of government need to understand the scale of this challenge to make meaningful progress.
It's a complex situation, but one that's crucial to address for the future of housing in Canada. We'll have to keep a close eye on how these developments unfold and what steps are taken to tackle this immense task. We're moving on to another significant topic today: the pressing need for increased housing construction in Canada. According to the Canada Mortgage and Housing Corporation, or CMHC, to bring housing affordability back to 2019 levels, Canada would need to double its current pace of housing construction, building between 430,000 to 480,000 units annually over the next decade.
That's a massive undertaking, Sandy. The CMHC believes it's achievable, but it would require a larger, modernized workforce, increased private investment, reduced regulations, and a boost in construction technology and labor productivity. Aled Abiorworth, CMHC's deputy chief economist, emphasizes that systemic changes are essential to meet these goals.
Absolutely, Steve. It's not just about building more homes, but about addressing long-standing systemic issues. The Canadian Real Estate Association notes that while the benchmark price index for housing fell from its 2022 peak, it's still higher than in 2019, putting home ownership out of reach for many Canadians.
Right, Sandy. And the challenges are even more pronounced in major cities. For instance, Toronto needs a 70% increase in home building over the next decade to tackle its affordability issues, despite recent growth in rental construction. The CMHC points out that home ownership options in Toronto don't align with local incomes.
Vancouver and Montreal are also facing significant housing supply gaps. Vancouver needs a 29% increase in housing over the next decade, while Montreal has the largest housing supply gap among Canada's big metro areas. Since the pandemic, home ownership costs in Montreal have risen faster than in any other large city.
It's clear that the housing supply needs to increase significantly to address these affordability challenges. Prime Minister Mark Carney aims to construct up to 500,000 housing units annually. However, the Toronto Dominion Bank has questioned whether these targets are feasible, even with proposed policy changes like cutting taxes on new homes.
The bank suggests that achieving these targets would require an unprecedented boost in productivity, a revolution in how housing is developed. It underscores the importance of not just building more, but building smarter and more efficiently.
Precisely, Sandy. While these measures might help, they may not completely close the gap. The CMHC is clear that systemic changes are needed, requiring collaboration between the private sector and all levels of government to make meaningful progress.
It's a complex issue, but one that's crucial for the future of Canadian housing. We'll continue to watch how these developments unfold and what steps are taken to tackle these challenges.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.